everyone, good day to you all. Today's video will be about partnership. So students, have you ever thought of doing business together with your friends once you all finish your college next time? And what will be the business of selling product or selling services? Have you ever guys thought of that? Or you guys prefer to do things on your own? So you would prefer to be sole proprietor. So nonetheless, we need to know what is the difference between a sole proprietor and also a partnership. So let's dig in. So normally partnership chapter will come somewhere around in your year 11 journey. Yeah, because all the basics are coming from your year 10, especially on the adjustments area. So definitely adjustments will follow you from sole proprietor, financial statement adjustments, partnership, clubs and society, as well as manufacturing accounts later on. Okay, so these are the basics that you all need to know. So a partnership is basically a business where two or more people work together to make a fortune, meaning profit. So it can be family members, professionals to form a legal firm or accounting firm. It can come from business combinations, meaning two businesses combine and merge together and form a new name with something similar product or maybe a brand new product. A sole proprietor changes to become a partnership, meaning there's a friend who comes in, want to help out, and they change to a partnership. So why we need partnership and what's a good thing? Well, you come up with your own capital and somebody else come up with their capital and you combine money. Okay, and then each other's knowledge and resources are combined together. We share our knowledge and skills as well as responsibilities and also the risk. We share together and you are not alone. So however, the take back is that you have to share your profit, and once you make some sort of a decision or ideas that you have in your mind, you have to share to everyone, and once everybody agreed to it, you have a unanimous consent, then a plan can be executed. Without somebody else's agreement, you can't do things together that fast. So there will be some time delay in this, all right? And once you form a partnership, you have to have an agreement. Okay, the partnership agreement is important in order to manage any future disputes and arguments. So in case of any argument arise, you can just show them your partnerships, your partners, okay, this particular agreement. Hey, isn't it that time we agreed that this? Why now you are telling that you want that? So partnership agreement is a black and white document. So everybody, oh, okay, noted. So we have the capital, the profit losses sharing in terms of a ratio wise, okay, and then interest on the capital, okay, because you bring in capital, inject capital to the company, so the company give you in terms of interest. So this to the company is some sort of a kind of an expenses. Salaries, okay, the company pay to you as the partners who run the business. However, when you make some drawings, there is an interest on drawings. So this is the one and only thing that is sort of like an income to the partnership, because if you take things away, so the company punishes you for taking things out of the company for your own personal usage. Interest on partner's loan, okay, a partner's loan is deemed as like a bank loan, and therefore the interest charge will be in our normal company income statement. However, the few things over here, it will be in the appropriation account, which you will see in a bit. Okay, so it's deemed as a bank loan for the partner's loan. However, if there's an interest on partner's loan that is yet to pay, meaning in an accrued situation, it will be placed under the current account of the partners. Okay, it's not under SOFP. Although the current account later on will be under the capital portion. We never place these interest accrued on partner's loan under the current liability. No, we put into somewhere called the current account. Okay, profit losses, okay, there will be ratios. And here is our profit and loss appropriation account. So it is after the normal profit for the year, meaning there's a sales minus the cost of sales plus income minus expenses, and then you minus off the interest charge for the loan. Okay, this is the interest on partner's loan over here. And then you get your profit for the year. Then after that, the second portion in your income statement will be adding on the interest on partners drawings. Okay, there may be pro rata. Okay, in case they make the drawing somewhere in the middle of the year, you need to pro rata. Okay, interest on capital as well. You pro rata when they bring in another additional capital. If not, it will be just a full 1 year kind of thing. Salaries, it must be reported the 12 months to remember the real figure, because we are still in the income statement kind of a portion. So income statement always shows the real figure that is supposed to be during the year within the accounting period, not after, not before. Okay. Now, then you get the profit loss. Okay, then after that, you have to share the profit, which will go into the current account, and you have to like some sort, minus off, then you get a zero after that. Okay, then capital account, you have two types of account under the capital portion. Okay, during the sole proprietor era that we are learning, okay, sole proprietor, our capital portion will show the opening capital, and then you add on the profit for the year minus off the drawings, then you get the closing capital for the year. However, for the partnership-wise, okay, partnership, it will be a capital account, one. There's two of them, then there's a total, A and B, and then there's the total. And then you have the current account for A and B, and you have the total, and hence the total for the capital portion. So capital account, only capital account, unless they have some additional capital that they bring in, so therefore you credit your capital. Now, current account, okay, we will normally perform, okay, for each partners under a columnar format. So depending whether the question asks you to do the current account or not needed to do the current account, we will instead straight away do them in the financial statement of financial position. Under the current accounts portion, we have an opening balance. So opening balance can be a positive, meaning there are a credit balance over here. This is the positive side. If they have a negative balance over here, balance brought down, it will be the negative part. Okay, you have to show it as a negative portion if there's somebody has a negative portion. Okay, why current account can have a debit balance, which is a not good thing, because they have made a lot of drawings in the past year, so therefore the interest on drawings is high, or maybe they have a loss, the company experienced a loss and they share the losses quite a fair bit back then. So the particular partners will have a balance brought down under the debit portion here, and therefore it's a negative thing. All right, so all these interest on capital is almost forever is the company is owing the partners. Okay, so current account is where that the partner is the things that the partner is entitled and charged with. It's like that the company, the partnership, owing the partners, things that the partnership is owing the partners. So that would be on the credit side, you will be credited all the things that is missing. They haven't paid them yet. Interest on capital is always the case. Interest on loan, you need to check how much loan they have paid so far. So the balance of the interest on loan that the company is still yet to give to the partners will be credited over to their respective accounts. And salary bonus allowance, again, is the balances that the company yet to pay within the 12 months. So let's say we have salary for the 12 months for Ali is 50,000. But the company only paid 30,000, and therefore there will be a balance of 50 minus 30, you get 20. So for just now we have Alibaba, Ali, A, let's call them A, 20 over here, 20Ks, still owing to Mr. For this A partner. Profit share, if it is a good situation, you have a profit, and if you have a loss, then therefore you have to debit it. Okay, so the only thing that we minus off from the current accounts will be the drawings, interest on drawings, and loss of the share. Okay, the losses. Hence, the others is all on a plus basis. Okay, and you arrive at the total over here. And so this is your extract of your SOFP. Questions will definitely ask you on the adjustments such as depreciation, accruals, and also those irrecoverable debts if they want to test you with a full-fledged income statement and a full-fledged financial position. Okay, so depending on the question, if they ask full details of the current accounts to be shown, then you please show them. And if the question doesn't ask you to give a full details of the partner's current account, probably they will ask you to open a separate T account for the current account. Therefore, the final fee of the current account, just put that in the SOFP. But either way, if the question never asks you to do any current accounts, please do so. If not, your SOFP will not be able to complete. Okay, so for further details and for further exercises, we shall do in our class as we meet, and or anytime when I'm free, I will upload some videos on our partnership exercises. Okay, so that's all for today, guys, and I shall see you in our next video. Okay, bye.